don't think a recession is particularly likely. Trade policy could induce one at some point, but I certainly don't think anything we've seen so far will create one. And also, we've got incredibly low interest rates, which are continuing to go lower, and that's good for the economy. We just went through a quarterly earnings season that went very well, with most companies reporting better than expected earnings. Revenue growth and earnings growth were both good, better than people thought there was going to be.
Okay.
So I think the economy's fine. I don't see an issue.
Larry, what about you? And it is interesting that we're all looking to these falling and negative bond yields as a cautionary sign. If we were assured the economy was okay, I guess we could take that as a positive.
That's right. Look, the turmoil we're seeing in the global financial markets are clearly sending a signal that a recession is knocking on the door. It's just not necessarily knocking on our door right now yet. And I think we talked to a lot of small business owners. They are taking a more defensive, measured approach. If you are in the shoe business in the Boston area, 70% of your imports are coming from China. That's an existential threat. If you're in the lobster business and you're selling lobsters to China and business is down 70%, that's an existential threat. But you see with the consumer data, in a consumer-driven economy, the consumer did not get the memo on the recession. Consumers alive and well. Walmart, same-store sales,
right. And Larry,
across the board. Lots of good things, Kelly.
It's interesting you say that because, you know, the journal's talking about trade policy, and the big concern, especially from the latest round of tariffs, is that they would more directly hit the consumer. Now, we've delayed about half to two-thirds of those, but still over $100 billion worth is going into effect September 1. Why hasn't there been a bigger impact on the U.S. consumer? Is it because the absolute amount is just not that large?
I think that's right, Kelly. Also, look, the biggest challenge right now for the economy as a whole is the tightness in the labor market. So the consumer feels very assured about their security in that labor market. They know they can get a job if they need one. Kelly, look, it's a global issue. And I think when we look at Europe, we realize how much better off we are than Europe. Europe's 6 to 12 months ahead of us. They've got negative interest rates. They're looking at potential for an infrastructure bill. I think in an election season, it becomes irresistible for politicians not to consider more inflationary measures, more infrastructure spending. It's the only card trick that hasn't been played by our politicians. And in a populist world, that's going to drive the economy. That gives individual investors an opportunity. Playing defense does not mean playing dead. It means looking for opportunities in this volatility. And there's lots of opportunities. Infrastructure stocks have been given up for dead. In Europe, dividend yields are much higher. That's your income replacement strategy for investors that can't get yield here. There's lots of opportunity. A weaker dollar means foreign assets go up in value on U.S. investors' books. So I think we have to look outside the box and start thinking differently in these robo-infested waters.
So, Steve, let me turn to you. You know, a growing economy is built largely on confidence, consumer confidence and business confidence, and both can be very fragile. When the stock market loses a lot of money the way it did yesterday, that gets investors' attention. All the talk of possible recession, that gets consumers' attention. And all of the whipsawing on trade makes it very much more difficult for businesses to plan. Wouldn't you agree, Steve?
Well, let me have a different take on it, Tyler, and that is that I think investors, for certain, should not get so wrapped up in the day-to-day activity of the market. I think the markets can be very, very volatile. I think you have to look at the overall economic facts. Interest rates are very low. The economy's doing well. There are lots of stocks out there with significant dividend yields that investors could buy. You could easily construct a portfolio yielding more than 5% of a whole host of equities. Think of ExxonMobil, Ford Motor, AT&T, all yielding more than 5% right now. So I don't think the market's that expensive, and I think investors should just, play it for the long term.
It really wasn't my question. It really wasn't my question. Right. My question really goes to it really goes not to what investors should do, but it goes to how consumers and business leaders may react to unstable conditions that they see.
Well, I think even businesses tend to have a long-term view right now. And yeah, we had a little bit of volatility this week. Our interest rates are actually catching up with Europe and with Japan, and I think that's more of what's going on than predicting a recession. Our interest rates have been the outlier. So I don't think this volatility, to answer your question, will really affect the ultimate decision-making by businesses or consumers that greatly.